Welcome to our comprehensive guide on advanced options strategies for income generation and hedging. In this video, we'll dive deep into the world of options trading. We'll explore strategies designed to generate consistent income and protect your portfolio. Whether you're a seasoned trader or looking to level up, this is for you. Let's start with a quick overview of what options are. Options are contracts that give you the right, but not the obligation to buy or sell an asset. The asset is typically a stock, and the contract has a set price and expiration date. There are two types of options, calls and puts. A call option lets you buy the asset, while a put option lets you sell it. Options are versatile tools for both income and risk management. Today we'll focus on advanced strategies to maximize their potential. Before we dive in, a quick disclaimer. Options trading carries risks, and you should consult a financial advisor before trading. Now, let's talk about income generation first. One of the most popular strategies is the covered call. In a covered call, you own the underlying stock and sell a call option against it. This generates immediate income from the premium you collect. For example, suppose you own 100 shares of XYZ stock trading at $50. You sell a call option with a strike price of $55 for $2. You pocket $200 in premium right away. If the stock stays below 55 by expiration, the option expires worthless. You keep the premium and your shares. If the stock rises above 55, your shares may be called away, but you still profit from the stock's gain plus the premium. Covered calls work best in neutral or slightly bullish markets. They're a great way to earn income while holding long-term positions. Another income strategy is the cash-secured put. Here, you sell a put option and set aside cash to buy the stock if assigned. This is ideal if you want to buy a stock at a lower price. For instance, XYZ is at $50, but you'd love to buy it at $45. You sell a $45 put for $1, collecting $100. If XYZ stays above 45, the put expires and you keep the premium. If it drops below 45, you buy the stock at a net cost of $44. That's 45 minus the $1 premium you receive. This strategy generates income while targeting stocks you want to own. Now let's move to a more advanced income strategy, the iron condor. An iron condor is a neutral strategy that profits when a stock stays in a range. It involves selling an out-of-the-money call and put, then buying further out-of-the-money calls and puts to limit risk. Suppose XYZ trades at $100. You sell a $110 call and a $90 put. You also buy a $115 call and an $85 put. The net premium you collect is your potential profit. If XYZ stays between 90 and 110, you keep the premium. Your maximum loss is capped by the outer strikes. Iron condors are popular in low volatility markets. They require careful management, but can be highly effective. Another advanced strategy is the bull-put spread. This is a bullish strategy that generates income with limited risk. You sell a put at a higher strike and buy a put at a lower strike. For example, with XYZ at $50, sell a $45 put, then buy a $40 put to cap your loss. The premium you collect is your profit if the stock stays above 45. Your risk is the difference between strikes minus the premium. Bull-put spreads are great for stocks you expect to rise or stay flat. Similarly, the bear call spread is for bearish or neutral markets. You sell a call at a lower strike and buy a call at a higher strike. This generates income if the stock stays below the lower strike. For XYZ at $50, sell a $55 call. Buy a $60 call to limit your risk. You keep the premium if XYZ stays below 55. These spreads are versatile for different market outlooks. Now let's shift to hedging strategies. Hedging protects your portfolio from adverse price movements. One of the simplest hedging strategies is the protective put. You buy a put option on a stock you own to limit downside risk. If XYZ is at $100, buy a $95 put. If the stock drops to 80, you can sell at 95. This caps your loss while keeping upside potential. Protective puts are like insurance for your portfolio. Another hedging strategy is the collar. A collar combines a protective put with a covered call. You buy a put below the current price and sell a call above it. For XYZ at $100, Buy a $95 put, sell a $105 call to offset the put's cost. This limits both your downside and upside. Collars are ideal when you want low-cost protection. Next, let's explore the bear put spread for hedging. This is a bearish strategy to protect against declines. You buy a put at a higher strike and sell a put at a lower strike. For size E's at $100, buy a $100 put. Sell a $90 put to reduce the cost. Your profit comes if the stock falls significantly. Your loss is limited to the net premium paid. This is cheaper than a standalone put but still effective. Another advanced hedging strategy is the iron butterfly. This combines selling an at-the-money straddle with protective wings. You sell an at-the-money call and put, then buy an out-of-the-money call and put. For XYZ at $100, sell a $100 call and put. Buy a $110 call and a $90 put. This creates a range-bound profit zone. It's best for stable stocks with minimal price movement. Now let's discuss managing risks in options trading. Advanced strategies require careful position sizing. Never risk more than you can afford to lose. Use stop-loss orders to limit potential losses. Monitor implied volatility as it affects option prices. High volatility can increase premiums, favoring sellers. Low volatility may benefit buyers looking for cheaper options. Time decay is another key factor. Options lose value as expiration approaches. This benefits sellers but challenges buyers. Always align your strategy with your market outlook. Let's look at some real-world applications. In 2025, markets have been volatile. Tech stocks, for example, have seen sharp swings. A trader holding a tech stock, like ABC at $200, might use a collar to protect against a sudden drop. They buy a $190 put and sell a $210 call. This locks in a price range for their position. Alternatively, they could sell covered calls monthly, generating 5% annual income on their holdings. For income-focused traders, iron condors have gained popularity, especially on broad indices like the S&P 500, with low interest rates in 2025. Investors are seeking yield through options. Strategies like cash-secured puts are also trending, allowing traders to enter positions at favorable prices. Now let's talk about combining strategies. You can layer income and hedging strategies. For example, sell covered calls on a core holding. Use the premiums to buy protective puts. This creates a balanced approach to risk and reward, or use iron condors for income on stable assets. While holding protective puts on volatile stocks, this diversifies your income and protection. Let's address some common mistakes. One error is over-leveraging your positions. Options amplify gains but also losses. Another mistake is ignoring transaction costs. Commissions and fees can eat into profits. Always factor these into your calculations. Failing to adjust positions is also risky. Markets change, and your strategy should too. Start small with these advanced strategies. Practice in a paper trading account first. This lets you learn without risking real money. Stay educated on market trends and volatility. Knowledge is your best tool in options trading. Finally, be patient and disciplined. Success in options comes from consistent execution. That's it for our guide on advanced options strategies. We've covered income generation and hedging in detail. From covered calls to iron condors and protective puts, you now have a solid foundation to build on. Thanks for watching and happy trading.